Many people know that leveraged ETFs can deliver very high returns. For example, 3 times leveraged index funds, such as TQQQ and SPLX, often outperform most active funds easily during bull markets. I mentioned in a previous video that a 3 times leveraged ETF like TQQQ had an average annual return close to 40% over the past 15 years, making it one of the best performing assets in the market. But at the same time, most investors still fail to profit from it. The reason is simple. These ETFs are extremely volatile and have deep drawdowns. Many investors panic during market swings, stop out, or quit halfway, missing out on the big gains. So, is there a way to earn the high returns of leveraged ETFs through long-term investing, while keeping risk under control? A recent research paper gives an interesting answer. It suggests that by using one simple indicator, leveraged ETFs can actually become suitable for long-term investing. In other words, we can use leverage to boost profit while using this indicator to manage risk effectively. In today's video, we will explore a data-proven, realistic leveraged investing strategy. Before understanding the strategy, we first need to know why leveraged ETFs are often considered not suitable for long-term investing. The root cause is their daily rebalancing mechanism. In a regular index fund, like the S&P 500, if the index goes up 1% in a day, you gain 1%. If it falls 1%, you lose 1%. But leveraged ETFs are different. A 3 times ETF will rise 3% when the index rises 1% and fall 3% when the index drops 1%. That seems fine at first, but here is the issue. Leveraged ETFs must rebalance daily to maintain the 3 times leverage ratio. If the index rises today, the fund has to buy more to stay 3 times leveraged. If it falls tomorrow, it must sell part of its position to adjust back down. When a market swings back and forth for several days, this repeated buying high and selling low compresses the ETF's value. Over time, its performance becomes much worse than the index itself. The paper gave a clear example. Between August 8th and August 15th, 2011, over just 6 trading days, the S&P 500 rose 0.51%. But the 3 times leveraged S&P ETF fell 2.02% over the same period. In other words, the index gained 0.5%, but the leveraged ETF lost 2%, almost 5 times the difference. That period was a classic volatile sideways market, dropping 6% one day, bouncing 5% the next, then falling 4% and rising again. This type of repeated up and down movement is the worst environment for leveraged ETFs. Their constant rebalancing in a choppy market leads to what's called volatility decay. This means even when the index stays flat or slightly rises, the leveraged ETF can still lose money. The paper confirmed this with data. It found that the long-term performance of leveraged ETFs depends not on time, but on 3 key factors: the market trend direction, the level of volatility, and how smooth the price path is. In simple terms, leverage does not fear time, it fears volatility. When the market swings up and down sharply, leveraged ETFs lose money because of the constant buying and selling. But when the market rises steadily, even with small daily movements, leverage becomes a compounding amplifier. For example, between April 24th and June 23rd, 2025, the S&P 500 had a stable uptrend. The index rose 9.85%, while the 3 times ETF gained 31.39%, which is 3.2 times higher. This shows that leverage's enemy is volatility, but its friend is trend. So, how can we identify when the market is suitable for leveraged investing? The paper gives a very clear answer. Use the moving average line. The author compared different time frames: 10-day, 20-day, 50-day, and 200-day moving averages. In every case, volatility was much lower when the price stayed above the moving average. When it fell below, volatility nearly doubled. For example, when the S&P 500 stayed above its 200-day moving average, its annualized volatility was only 14.6%. But when it fell below, volatility jumped to 26.9%. The longer the moving average, the bigger the gap between the two. This means moving averages are not just trend indicators, they are filters. When the price is above the average, the market is stable and smoother. When the price drops below, volatility spikes and the market becomes unstable. The paper also included a chart confirming this. Among the worst 1% of trading days in history, 69.4% occurred when the price was below the 10-day moving average, and 74.1% happened when it was below the 20-day moving average. In other words, most extreme drawdowns occur when the price is below the moving average. This shows that moving averages not only help identify trends, but also separate risk levels. You can treat them as a risk management tool. When the market trades above its moving average, it is safer to use leverage. When it falls below, you should be cautious or avoid leverage positions altogether. Based on this finding, the author proposed an investment idea called the leverage rotation strategy, or LRS for short. The logic is very simple. When the closing price of the S&P 500 is above a certain moving average line, you buy a leveraged ETF such as SPLX or TQQQ to gain exposure to the index. When the price falls below that moving average line, you sell all positions and move entirely into bonds or cash. In other words, during high-risk periods, you do not just reduce exposure, you completely exit risky assets. The author also mentioned that in the modern ETF environment, switching to cash during risk periods can better isolate volatility. So how effective is this strategy? Let's look at the results in the paper. From October 1928 to December 2020, the traditional buy-and-hold S&P 500 strategy delivered an annual return of 9.4%. Using 3 times leverage directly raised that to 16.2%. But applying the 200-day moving average in the LRS model boosted the annual return to 26.7%. To put it in perspective, if you had invested $10,000 in the S&P 500 in 1928, by the end of 2020, it would have grown to about $39 million. But using the same $10,000 with a 3 times leveraged LRS strategy, the final value would reach an incredible $28 trillion. More importantly, this strategy reduced risk significantly while maintaining high returns. During the worst bear markets in U.S. history, the LRS strategy showed much better downside protection. For example, during the Great Depression of 1929, the S&P 500 dropped 86.2%, but the 3 times LRS strategy fell only 49.6%. In the 2008 financial crisis, the S&P 500 dropped 55.3%, while the 3 times LRS fell only 31.5%. That in other words, the leverage rotation strategy not only helps investors boost returns, but also effectively controls risk. Today, there are many leveraged ETFs available for implementing this strategy, such as SPLX, which is a 3 times leveraged S&P 500 ETF, and TQQQ, which is a 3 times leveraged NASDAQ 100 ETF. These ETFs usually have expense ratios below 1%. Compared with the potential return from the LRS strategy, this cost is almost negligible. However, there is one very important detail to pay attention to. When applying the LRS strategy, the moving average used must be based on the index itself, not the leveraged ETF. In other words, if you're investing in TQQQ, you should refer to the 200-day moving average of the NASDAQ 100 index, not TQQQ's own 200-day line. Because leveraged ETFs rebalance daily, their prices can deviate from the index over time. Using their own moving averages would cause large signal errors and may even break the strategy. Of course, every strategy has its limitations. The paper also pointed out that LRS is not perfect. First, moving average signals are lagging indicators. They usually trigger a sell signal after the market has already declined for a while. Second, in sideways markets, there can be false breakouts, causing frequent switching and reduced performance. In addition, this strategy requires strong discipline. If you let emotions interfere and change the plan midway, even the best system will fail. The author suggests keeping the leverage ratio between 1.25 times and 3 times. This provides a more balanced risk-return profile. The main insight from this research is that leveraged ETFs are not unsuitable for long-term investing. What matters is managing volatility. As long as you can use indicators like moving averages to separate trending markets from volatile ones, you can control risk effectively. When done right, leveraged ETFs can become tools for enhancing long-term returns rather than just short-term trading instruments. Investment success has never come from predicting the market. It comes from managing volatility and sticking to your plan. Compounding rewards those who can stay calm through market swings. This study gives us an inspiring idea. Leveraged ETFs do not have to be short-term trading tools. With the right risk management mechanism, such as the LRS trend rotation strategy, we can still pursue higher long-term returns under controlled risk. The key is not whether you use leverage, but how you use it. Once you understand this, you can turn leverage from a speculative tool into a long-term weapon for building wealth efficiently. If you found today's content helpful, please give it a thumbs up and share your thoughts in the comments. Would you consider using a strategy like this for your leveraged ETF investments? If you have not subscribed yet, do it now so you will not miss future videos on investing strategies, portfolio management, and long-term wealth growth. See you next time.